Good day, everybody, and welcome to today's class. It's Sam King here, and I'll be your host for today. Now, in the previous class, in the previous video I posted, I did a basic introduction to liquidity. I explained liquidity using an illustration, using a story, and I said liquidity is more like the fuel that a car needs to move. Now, the car in that illustration is price, the direction in which that car is moving. I gave an example of a bus driver going from Lagos to Abuja. So Lagos to Abuja, the direction that that car is moving is the market structure. Liquidity is the fuel, and liquidity levels where you can find liquidity is more like your filling station. Now, just a quick recap of the previous video. So starting point Lagos, ending point Abuja. Now your price, which is your bus driver, your price which is a bus driver, needs to go from Lagos to Abuja. Then on his way to Lagos to Abuja, his main motive is to actually get to his destination. Then his other objective is to not run out of gas, which will actually help him get to his final destination safe and sound. So like he left from his destination, his home, got midway, he was running out of fuel, he went back to get fuel. Then he just kept doing the same thing over and over again. Got fuel at the nearest place, went tired again, get back to get fuel, and just like that. So like the bus driver has a tendency to stop every now and then to pick up fuel from gas stations before continuing his journey to the direction. Now the same thing applies to the markets, whereby price moves from when price is moving in a certain direction, price reverses or it retraces to come and sweep liquidity and then continue in the direction that it's going. That is how liquidity basically works. Now, I said, how can we identify liquidity? I said the basic ways to identify your liquidity level is an area of equal I, an area of equal I, an area of equal I, an area of equal I. This is just a review. I just want to like go over it real quick. An area of equal lows and an area of equal lows and trend line liquidity. So, I think I messed that up. Hold on. An area of equal I, equal low, and trend line liquidity. Now, in this example, this is an equal I. When you see an equal like this, think of this as a gas station. There is liquidity here for price to come back, pick up, then continue. So this is an equal high. Price came back to tap liquidity, to sweep liquidity from this height, then continue the direction I was going. Then the same thing applies to that of equal lows too. You see price come back here, you see price come back here, sweep liquidity, then continue. So like when next you want to approach the market or you want to identify liquidity level, just have this illustration at the back of your mind. Liquidity is like your liquidity level is like your filling station. That is the price goes to gain fuel such as to continue in the direction that it is going. So in this case, you see liquidity resting at these highs, liquidity resting at these lows. Then in a case like this, when you have your trend line liquidity, next the price from the trend line. You see price do something like this. So there is most likely liquidity resting here on this trend line. Now, these are the basic ways to actually identify your liquidity level. Now, do you go around marking out every high, every low on your charts? Definitely not. Now, moving on, we need to understand two basic types of liquidity that I explained in the previous video. I said your internal range liquidity and your external range liquidity. Now, first of all, what is a range? First of all, what is a range? A range is just it's comprised of three. Is A range is made up of three things. You have your swing low, your swing high, and your break of structure. That's basically what you need for a range. So like it could be inverted. In the case of of an uptrend, this is a swing low, this is a swing high, then this is a break of structure. Now our range is basically this distance between this low and this high. That is what our range is. In the case of a downtrend, you have a swing high, a swing low, and a break of structure. You have a swing high, a swing low, and a break of structure. Now in this case, that is what our range is. This distance between this high and this low. That's what our range is. Now, the two types of liquidity I mentioned in the previous video, I said we have the internal range liquidity and the external range liquidity. Now, the internal range liquidity is basically a liquidity level that I can find inside this range. Inside this range, this will distance like this. Your internal range liquidity is your liquidity level that you can find from here to here. That's your internal range. That is where you can find your internal range liquidity. And your external range liquidity is something you can find within. Sorry, your internal range liquidity in the case of a downtrend is the liquidity level I can find between here and here. Now, for example, if you see something like this, if you see something like the previous thing I mentioned where I said equal highs or equal lows, let's say you see something like this, when price was moving down, you created something like this, like an equal high, then went down, then that means this is a liquidity level. Now, what kind of liquidity level is this? This is an internal range. You classify this type of liquidity as an internal range liquidity level because it is inside the range. It is inside the range. Don't forget, the previous example I gave was to identify areas of liquidity. Now, liquidity can also be found at highs and lows. It's not just equal highs and equal lows, but I just want to give you guys an understanding of how you can actually identify liquidity, how you can, where you can look to actually identify liquidity before I proceed to how you can identify liquidity at highs and lows. Now, like I said, if there were to be a double bottom here too, or an equal low here, when price surge up, that tells you one thing that this is most likely a liquidity level that price will come back, to come and sweep, then continue. That's what you expect price to do to every liquidity level. So, like, you expect price to come back here, take out this liquidity, then continue. So in the illustration I gave, price comes back here to fill up its gas tank, then continue the direction that it's going. So that is that for internal range liquidity. Now, for external range liquidity is actually very simple. If you are on an uptrend, the external range liquidity is found at your swing high here because you are going to the upper side. Now, there is what we call protected eyes and weak eyes. That's another thing entirely to talk about. So, like there's what we call protected eyes and weak eyes. Now, protected eyes are sorry, protected levels are those levels that when price take them out, you tend to see a change in direction or a change in trend. So, like a protected level is more like a U-turn point. When a driver is driving, let's say a driver is driving north, then he gets to then he gets past this U-turn. Let's say this is the U-turn level. When the driver makes a U-turn back here, and takes a U-turn at this place, you can expect him to start going south because he was going north initially. But like immediately he makes a U-turn at this point, it is going to start going. The driver is going to start going to the opposite direction. So that is what a protected level is. A protected level is like a place of U-turn. When price gets to a protected level and it goes past that protected level, it is most likely going to change direction. That's how you get your change of character or your shift in market structure, whatever you call it. So like a protected level is hold on. So that's what a protected level is about. Now, I was explaining external insecurity. Your external insecurity is found at your weak level. Now, your weak level is that high or that low that price needs to take out for the trend to continue. So if you're on an uptrend, your weak level is usually found at your highs, at your weak highs, because price needs to take out an high for that uptrend to continue. Then if you're on a downtrend, your weak level is going to be at your lows because price needs to take your low before the trend continues. So all that being said, your external liquidity is found at your weak levels. Your external liquidity is found at your weak levels. Now, your external liquidity in this case is this high right here, this high, because this is an uptrend and this is a weak high. So, like your external liquidity is found at this high. You can call it a weak high or you can call it an external liquidity. For the case of a downtrend, our external liquidity is found at our weak low. This is a weak low. External range liquidity. So, like once price needs to take your internal liquidity for the trend to continue. That's all wow, that flies. So that is that about internal range and external range liquidity. That's all about internal range and external liquidity. Now you can identify liquidity as a single high, like at a single high like this, or a single low. Let's say you have a trend like this, then price does something like this and comes back. In this illustration, This is just an eye. This place is just an eye. And for this trend, this is our liquidity level. So how do you know which eye or which low to mark out as your internal range liquidity? Because this is a bearish range. This example is a bearish range. Then you see price create this eye on its way down, then come back to clear that eye at the liquidity level, then continue. You must have seen this entry model somewhere. You must have seen this on Twitter somewhere. So like this is our internal liquidity level in this scenario. For the case of an uptrend, for the case of an uptrend, price comes back and continues. Now for this case, this is going to be our internal range liquidity. This is going to be our internal range liquidity for this case. Now, how do you know which high or which low to mark out as your internal range liquidity? Earlier here, I was explaining something about protected highs and protected lows. Now, let's say you have a range like this. If you don't want to mark out, or if you probably don't see an equal low, if you don't see an equal high, if you don't see a trend line sort of liquidity within this range, what your liquidity level is going to be is the closest low to this protected low, the closest one to this protected low. Oftentimes, that's where your liquidity is going to be. So when you have this low, the nearest one to it is where the liquidity is going to be. Now, after this nearest liquidity, price usually comes back down to take out this liquidity, then continue. That's where you can find your internal liquidity. Take note, the closest low to your protected low. Now, in the case of an uptrend, sorry, in the case of a downtrend rather, in the case of a downtrend, rather, it is the closest eye to your protected eye. That is where your internal liquidity is lying. That's where your internal liquidity is lying. So let's just go on the charts. Let me go on the charts and look for examples for you guys. Let me go on the chart and look for examples. Do we have 15? Let's just let me see. Let me see. Let me see. There was an example I saw here. There's an example I saw here. Okay, let me use this one for an example. This is a break of structure. 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 So this is a swing high. This is a swing low. This is a swing high. This is a swing low, and this is a break of structure. And that means this is our range, right? That means this is going to be our range in this example. Now, I said there are ways you can actually identify liquidity, and one of them is an equal high. Now, this is an example of an equal high. It is not that equal, but like the highs are actually close to themselves. This is an example of an equal high. This is an example of an equal high. And as you can see, price came back, took out this high. Price took out this liquidity level. Price took out this liquidity level, then continue to the downside. But like that is not the example I actually want to give. I said your internal liquidity is usually the closest high or the closest low to your protected level. Now, where is the closest high to this protected high here? These are protected high because on the downtrend. The closest high to this protected high is this place. Now, this is going to be our internal range liquidity. Now, I am not saying this is the only liquidity level within this range. I am not saying this is the only liquidity level within this range. This is the liquidity level. This place is a place of equal. It is the liquidity level. But like the one you want to pay attention to the most is the closest one to protected level. So now I marked this out. Let me say I marked this out. This is my internal liquidity. And after some time, price rallied, then came back and swept this liquidity level, swept this internal liquidity level. Liquidity. Then I said our external liquidity is our protected, is our weak level. Our external liquidity is our weak level. External range liquidity. And price already took the external liquidity and created a new one because for every external liquidity that is taken, a new one is created. Now, what does that mean is that when price takes out an external liquidity, when price takes out a high and you are still going up, a new high is created, then price retraces and takes out that high and repeats the same thing over and over again. So for this trend to continue, price took out this external liquidity and created a new one here. Now, after price created the new external liquidity ARL, price came back and took this internal liquidity IRL. Price came back and took this internal liquidity, then tapped into a POI here and continued. We might get to POIs in the course of this whole thing. So like as you can see here, we had a range, a swing high, a swing low, then our liquidity level, our closest high to our protected high. Then price came, swept the internal liquidity, then continued to the downside. And let me see if I have more examples. Let me see if I have more examples. In my opinion, PTC has been backed by a lot of fundamentals lately. So like the price action has been. Do I have an example on gold? How many times do I have left? Okay. I have about 5 minutes left. So I'm just looking for an example of an internal range liquidity, internal liquidity. The setup here. Make an example of an internal liquidity. Private. So this is going to be quite confusing. This is going to be quite confusing, but like I'll just go with this example. This is a brick of structure. This is a brick of structure. This is a brick of structure. Is this a good example? No, let me look for something else. Look for something else before it gets complicated. Okay, good. I think I have one here. I think I have one here. So our time frame. So our time frame. So this is an example of a good range. This is an example of a good range. We have our swing low. We have our swing low. Then we have our break of structure or our change of character that created the range. Then we have our swing high at this extreme point. This is our swing high for this range. Now I said our liquidity level is our closest low to our protected low. This is our protected low, and this is the closest low to this protected low. So you mark this out as your internal liquidity, internal range liquidity. Now, this can also be called inducement in some cases, but like we eventually get there in the next part of the video. So like we have internal liquidity, this is our internal liquidity, and external liquidity, this I up here. These are external liquidity. So the trend is bullish within this range. This is a bullish range. But like for this trend to continue, we need to see price take out this external liquidity. So that's what I'm basically waiting for. This is an example of an internal liquidity, and we have another example of the lower time frame. So we have other examples. Other examples. Other examples. Okay, another example. This is another example. This is the I. Let's just take this as. Should I take that? No. This is a swing high. This is a swing low. This is a swing high. This is a swing low, and this is the closest. This is the closest high to this protected high. So that means this is our liquidity level. Then, as you can see, price came back to take out this liquidity. It took out this liquidity, tap into the nearest POI, then continues to the downside. Price took out liquidity, tap into the nearest POI, then continue to the downside. So like when next you're on your chart and you're looking for trying to figure out what liquidity is, just bring this story at the back of your mind. So where is the nearest trading station that price may actually come to before continuing to the direction that it is going? And bear in mind your internal liquidity is any liquidity level inside of your range. Don't get it twisted. Your internal liquidity is any liquidity level inside of your range. But the most important one is the closest one to your protected level. The most important one is the closest one to your protected level. Because in this scenario, this is a liquidity level. Still a liquidity level for this range up here. So like every I or every I within this range is most likely a liquidity for this POI here. But like the one you want to take note of the most is the closest one to either a protected I or your protected low. Now, if we were to like use the same example, if we were to use the same example here, if we were to use the same example here, This is AI. This is a